Hey everyone, welcome back to Corporate Decoder. Today, Tianci International Incorporated just filed an amended S-1 registration statement, and I am seeing some serious red flags for investors. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing is all about a new offering of shares and warrants. But the devil is really in the details of how this could dilute existing shareholders and potentially lead to a Nasdaq delisting. Alright, let's dive into this S-1 filing from Tianci International Incorporated. This company is looking to raise money by selling units. Each unit contains one share of their common stock plus one warrant, which is basically a ticket to buy another share later. They're also offering pre-funded units, which are a bit more complicated, but essentially serve a similar purpose for certain investors. Now, right off the bat, they admit their stock price is all over the place. This is a company where the stock price has been very unstable, and lots of things outside their control can make it go up or down dramatically. Here is a big one. Back in October of last year, Nasdaq sent them a notice saying their stock price had been below $1 for 30 days straight. That is a problem because Nasdaq has rules about minimum stock prices, and if you don't meet them, you can get delisted. They were given time to fix it, and apparently they did manage to get back above $1 for a while. But the fact that this is a concern so close to this new offering is pretty telling. This offering itself is going to be highly dilutive. They're issuing so many new shares and warrants that it will represent over 20% of the company's total stock right after the deal closes. Dilution means your ownership percentage goes down, and if a lot of new shares hit the market, it can push the stock price down. And it gets worse. They explicitly warn that Nasdaq could halt trading or even delist them because of this offering. They mention that similar stock and warrant structures have caused other companies to drop below Nasdaq's minimum price or face delisting. This is a serious warning. Think about what happened with companies like Sears, which went through multiple reverse splits and eventually delisted, or Bed Bath & Beyond, which struggled for years before its demise. Many smaller companies that do these kinds of dilutive offerings often see their stock prices plummet further, and this is a very common path towards eventual delisting. The CEO, Shufang Gao, owns a huge chunk of the company, over 55%. This means he has a lot of control. While that can sometimes be good for decisive leadership, it also means that other shareholders don't have much say in how the company is run. This concentration of power can sometimes lead to decisions that benefit the majority shareholder more than minority investors. Speaking of risks, the risk factors section here is extensive. It is packed with warnings about volatility, limited trading markets for the warrants, and the constant threat of being delisted from Nasdaq. It is clear the company itself is very aware of the precarious situation their stock and potential new issuances put them in. They repeat that their stock price is likely to be very volatile and could cause big losses. This is because of market swings, competition, and potential lawsuits, among many other things. Here is a really technical but important point about the warrants they're issuing. These warrants have a feature that can actually lower the price at which they can be exercised and increase the number of shares issued if the company does certain things like a reverse stock split, which they've already done and are planning to do more of. This is a complicated way to say that if the stock price drops or they do more reverse splits, the dilution from these warrants could get a whole lot worse. This is effectively a built-in mechanism to heavily dilute existing shareholders under certain circumstances. They also identify themselves as a smaller reporting company. This means they get to follow fewer rules about what they have to report to the public, which can make it harder for investors to get a full picture and potentially make the stock less attractive. It is a bit of a double-edged sword. It saves them money and hassle, but it can also signal a lack of transparency or financial robustness to the market. An interesting note here relates to the Holding Foreign Companies Accountable Act, due to concerns about US regulators being able to inspect audits in China and Hong Kong. Foreign companies can face delisting. Tianci S-Auditor is based in the US, which is a positive point, but the risk associated with China. Related accounting oversight is still a background concern for many companies with operations there or subsidiaries there. They've hired Maxim Group LLC as their placement agent. This means Maxim will try its best to sell these units, but they aren't obligated to buy them. It is a best efforts offering, which means there is no guarantee they'll sell enough to even get the deal done, or that they'll raise the amount of money they hope for. This also means investors might not get their money back if the sale doesn't go through as planned. Maxim gets a hefty commission of 7% plus reimbursements for expenses. They also get warrants to buy more stock. This means a good chunk of the money raised goes straight to the placement agent. And then there are the other expenses, legal fees, accounting fees, totaling around $358,000, plus the placement agent's fees. This all leads into the actual money the company gets to keep. Another crucial detail is that if they don't keep their prospectus up, to date warrant holders can only exercise them on a cashless basis. This generally means they get fewer shares than if they had paid cash. It is another layer of complexity and potential downside for warrant holders. Looking at their capitalization, they have preferred stock, which can often have special rights that can be unfavorable to common stockholders, especially in a liquidation scenario. While they don't currently have preferred stock outstanding, the authority to issue it is a lingering risk. Let's touch on the capitalization table as of the 31st of January 2026 on an as adjusted basis, meaning after this offering, they're projecting about $7.8 million in total capitalization. This is up from about $2.6 million before the offering. So if they sell all the units as planned, they'll see a significant cash injection. But here is the kicker on dilution. The filing estimates that new investors buying into this offering could see an immediate dilution of about $0.32 per S-share. This means if you buy in at $1.25, the tangible book value behind your share is only $0.93. That is a significant immediate hit to the theoretical value of your investment. For comparison, when a company like Kodak did a 1-for-20 reverse split in 2021, holders saw roughly a 40% additional drawdown over the following 90 days. While this isn't a reverse split, the principle of new share issuance causing further immediate value loss for new entrants is very similar. A $1,000 investment here could see its tangible book value drop by around $250 immediately. And don't expect any dividends anytime soon. They haven't paid any and don't plan to. All profits, if any, will be reinvested. This is typical for growth companies, but it means investors are solely reliant on stock price appreciation, which is made riskier by all the dilution and delisting concerns. The story here with Tianci International Incorporated is one of risk. They're trying to raise capital through a highly dilutive offering, and they've already had trouble meeting Nasdaq's minimum stock price requirements. The warning about potential delisting is very direct, while the company is in the logistics business, and that is a vital industry. The way they're structuring this offering and the existing financial instability documented in the filing are major red flags. The key risk I am watching is whether this offering will actually help them regain stability or just accelerate their path towards delisting. What I am actually looking for is a significant improvement in their underlying business operations that can sustainably keep their stock price above that critical dollar mark and avoid further dilution penalties. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Check out the community Discord linked in the description.